Good morning, everyone who's online, or afternoon if you're watching this and recording later. So jump into the summary of last year. I think a solid year of progress, I hope, for the organisation. I think if we look at the PBT performance going from a poor year last year of 0.3 up to 2.6, and importantly, meeting the expectations that we put out in the market originally of 2.5 is pleasing to get the group pointed in the right direction. That is despite, as you can see, NFI being down 2% year on year. I think within that, we've got marginal contract growth, 2% growth on contracts, which has shifted us back to 74.26. But one of the things we've been really focused on is wanting to work on good quality business. And during the year, we've been exiting some large NFI but low profitability programs, which has meant a slight drop within the NFI, but clearly the improving profitability for the organisation and focus on good margin business. So we've had some standout performances within areas like defence, where we have a huge pedigree. It's been part of our DNA for almost 40 years now. And our biggest part of our business is the infrastructure market, which saw growth last year and combined over 50% of the organisation now. Gattaca Projects is our statement of work business. We've been doing this for about 10 years now. That's really matured over the last couple of years of clarity around the service offering and depth into major client rather than reacting to smaller market opportunities. And we're excited about the prospects for Gattaca Projects for the years to come. And as I say, good to see the contract perm split moving in the direction we wanted, albeit most of that is because of the exiting of the high volume but low profit perm organisation. And really the year ahead is about constant focus on growing that contractor book week in, week out. Net cash, Oliver's team have done a good job on cash. See a big increase from 12.3 to 21.6. Threefold reason for that, probably. Number one being the DSO improvement as we've bedded into our new technology stack and managed to improve that back to the levels it should be. Secondly, some of the contracts that we were exiting were cash rich but margin poor, so that throwing off cash by exiting that, and equally a really good performance from a very settled team as well. So good to see that improving, and I hope to during the year as we grow our contract book in the future year, that we're actually starting to see that reduce as we start using that cash to fund the contract book. But we've got the dividends as per our policy, 2.5p, which is as per our policy of 50% after tax, and the special dividend really to recognise that a lot of our shareholders are a yield stockholders, and we haven't been in a position to be able to pay out a dividend. So it's a nod to them for thanking them to stick by us during the times where we weren't in a position to pay out a dividend. So good progress on the economics, really pleasing. I'm really happy with how the business has embraced the changes since Oliver and I came in 18 months ago. The four pillars that we've really hung everything off around the organisation. We've made really good progress, and on the next slide we've got a summary of what we've achieved. But fundamentally, everything that we said we would do, we have done that. We as a business in our customer environment have an excellent reputation for delivery, and I'm really keen that we have an equally excellent reputation for delivery within the shareholder community as well, on everything we're promising. The external focus, the biggest one for that, we had made a number of acquisitions over the years, and we were carrying too many brands and had a confusing go-to-market. And it's been something on the agenda for a really long time, but actually we've nailed that this year. Tidied up our go-to-market strategies, streamlined, so we have all of our STEM recruitment into our MatchTech brand, which is a really, really credible brand and a strong position. Our professional skills, so our business, our corporate head office requirements for STEM companies under Barclay Mead. And then we have Gattaca Projects and Gattaca Solutions, which are doing outcome-based work or workforce solutions and strategy for solutions. So clear go-to-market, great that we've achieved that. And really, I'm pleased to see the business start getting more external. Over the last 3-4 years, we've been going through a lot of internal change, a lot of it necessary, operating model, financial structure, technology stack, etc. but it really had made us very internally focused. And part of our last 12 months has been getting the business, rebuilding its capability and confidence, and getting back out into the market. And the brand architecture changes in May were the final piece in the jigsaw for really enabling that. So excited as to what we will be doing over the next 12 months on that as well. Culture was a really big one for us from day one. We've always had a really strong culture right at our very core, but over the last number of years, it had waned, and we'd seen high attrition, low engagement, which brings about lower discretionary effort, lower performance. And the business has really embraced the changes that we've driven through over the last 18 months. Our engagement has really shot up. Our retention has really improved. We've even welcomed back 25 boomerangs, as I call them, so alumni that had left us for their own reasons and through some of those darker years, but seeing how exciting and the positive journey we're on, and wanting to come back and be a part of that. And culture is something that we will continue to obsess about. But it isn't just about welcoming anyone back. It's about really raising standards. And we've now completed a full year of our new performance management approach that has everybody in my business every quarter at the same time going through the same review process, which is looking not purely about financial performance, but financial activity and behaviors in a really consistent way, and has really enabled us to understand who are our superstars, who are our people who need support, and importantly, who are the people who it's not going to work for, and getting to them quicker. If you look back over the history of the last few years, we've probably been carrying people too long if they weren't going to make it, or bringing them into an environment where they couldn't be successful and then opting to leave. We've really tackled that, and I'm really happy with the progress we've made on that this year, and excited about what that means for the organisation for the year ahead. On the operation performance, a lot of good progress. We spent a lot of money putting in a complete new tech stack overhaul. That was significant disruption for the business. That now feels like BAU. We're not talking about legacy platforms anymore, and it's about iterative advancements. We've bolted in a couple of exciting new products to help people both with candidate identification or automation of processes to reduce admin burden or improve customer consistency. So really starting to see that forward, and raising our standards through this next 12 months is really important to us. And now we've got complete visibility of everyone's activities, everyone's styles, everyone's processes. We're able to drive that in far better control than we have done for years. And then cost rebalancing was clearly an important one. Balancing our estate portfolio was a key aspect to that, and Oliver can talk to the figures, but equally simplifying the business. We were running 45 payrolls with 70 plus legal entities. We've streamlined the payrolls down to 4. We're shifting to a single bill, tidying up our corporate structure. All of this stuff enables us just to be a simpler, more efficient organisation, so that we can reinvest in the right areas. And this is about rebalancing. We have invested far more now into sales headcount growth, BD growth, marketing growth, and tools to help us be a better winning business. So very pleased to see the progress that we've made in the last financial year on that. Moving forward, we've got a clear plan of what we want to be doing. We're in that phase now of building out a centralized business development function to feed longer opportunities, and that's already starting to build a pipeline, which is great. The brands are getting far more out there, both at a skills generation and a thought leadership, which just helps with the whole client acquisition journey and candidate attraction and retention journey. And we've got clear plans as to where we're investing. So our plan is during this new financial year to be growing our sales headcount by about 10%, but in very specific areas where we see great opportunity for us to scale and grow our market presence. So that's really, really pleasing to see. From a cultural point of view, we've got a great environment now. We haven't been able to say that for a good number of years, but it's a business with good energy, an environment where people are bought in and want to stay into the organisation. And really, this next year is all about how do we provide the space and the consistency for us to rebuild our corporate memory. I think it's something that we really lost during the acquisitions and some COVID times, etc. Rebuilding that corporate memory so people just know what it takes to be successful and they're supporting each other along the way. Again, operation performance, it's raising those standards, consistently looking for better, but also looking to do it in a different way. The fact we've been able to deploy some of the improvements around single pay, bill and automations with ease is a result of all of the hard work and money that we put into the tech stack overhaul over the last few years. but now enabling us to really focus on external performance, which will improve that top and bottom line over the years to come. And again, continue to focus on the rebalancing. We're at the back end around some of the automations and also the corporate structure. That then gives us opportunity to look at further savings in the future, as well as making sure our estate is right-sized in all of our locations. And we've got a couple of opportunities in this new financial year to do that in the UK as well. From a sector point of view, infrastructure is our biggest sector. That infrastructure for us is rail, water, highways, and the public sector. All of them, we have great heritage. All of them, we've got well-established teams. I think the brand architecture is really helping us to be more efficient. If I take rail as an example, we were going out to market as networkers for technology skills and requirements in the rail sector, Matchtech for some engineering ones, and RSL for some site. All of that now we go out to market as Matchtech. It's enabled the whole story to be more consistent, enable us to cross-sell, upsell far more efficiently. Clearly, as a sector, there's lots of press around HS2, and that does have a knock-on for the market. I'm sure it will slow the market down a little bit. Most of our exposure was to the first leg, but equally the announcement that Rishi's made around the other programs, they were already being talked about. They may just have a bit more guarantee of some funding coming through, and will generate, if it's not opportunities in rail, there will be more opportunities in highway, water, and also transmission and distribution, which is in our energy sector. So it is a market which is going to be a little bit softer. We certainly did see perm being a lot softer. We've traditionally been very, very strong in contracts and built a perm capability over the last 3 to 4 years. Perm has been very, very slow, but we are seeing signs of the contract recovery coming, and we are shifting our focus more and more to grey and white collar requirements as well during the year ahead. Defence, clearly no one wants to have the macro political environments that we do have at the moment, but we do have them. This is a market we're really well established. We have a very solid team. We are well positioned within the various tiers of the supply chain in the defence market. It's one we saw a good year from this year, and despite one of the programs that we were exiting during this year being a big Permi one, which will impact the NFI growth next year for defence, we still see that maturing nicely during the next 12 months. Energy is one I'm really passionate about. We have made a specific play to grow our energy capability and footprint, really focused on both renewables and also transmission and distribution. Renewables often gets the headlines and aligns very closely to our purpose, which I'm very passionate about. But frankly, the plumbing in this sector is just not up to scratch. And there's a huge amount of investment within transmission and distribution. And they will be where our bigger investments, and we're building specific teams at scale in this half year one for the new financial year. Mobility, for us, that's aerospace, automotive, and then the commercial marine. Again, markets we have great heritage on. Markets that really did get impacted and teams that did get impacted during the downturn. Aerospace, an example, really is only in the last sort of 12, 18 months started to recover in earnest. Flights are up to very similar pre-COVID levels. Airframe orders from the likes of Air Turkey, Air India are huge and put pressure on the likes of Airbus and Boeing, which they've not seen for many years, and therefore their supply chain. That will generate demand. The slight challenge in that marketplace is it really has lost a workforce and a tier 2 and tier 3 supply chain, which pivoted to other sectors during its downturn. But we are well positioned, and we've been scaling that area during this financial year and see an exciting future ahead for us as well. As far as other sectors, technology has been in the press a lot. We certainly weren't immune to the downturn in the technology marketplace, both in the UK and the US. We saw a real slowdown. This was more perm for us than contract as far as our positioning. We were more 50-50. Perm went very, very slow. We have not seen it get worse over the last 6 to 9 months, and we're starting to see the contract improve. We've also used this as an opportunity to get our internal structures. We are on a slightly different journey to most companies in the market, in the fact that we have been for the last 18 months improving the business and doing a number of self-help measures. Technology or TMT is an area where we really see the results of some of those coming to life during this next financial year as well. And then international, we have a small footprint internationally that hasn't performed well in the last financial year. again, hugely impacted by the perm technology downturn. We had a major RPO for cyber skill sets in the US, which literally went on stop within a few weeks of the new financial year. That clearly has impacted our performance across international, and it's something that we're really focused on improving in this year ahead.
Cool. Thank you, Matt. So turning to the financial results, NFI in the year was down 2% at 43.4 million, down from 44.2. Key driver of the decrease was the decline in the permanent recruitment side of the business, which declined by 11% from 12.9 down to 11.4. That was offset by growth in contract of 2%, which shifted our mix towards 74% contract, 26% perm. And over the long term, we'd like to, we see the business as getting towards an 80-20 contract to perm mix, which really links to the history of the group, which was always contract biased, the nature of the sectors and markets in which we operate, which have a strong and consistent demand for contract, and the favourable elements of contract revenue for us, which give us that visibility and stickiness with the clients, which really gives us sight of where the future NFI is coming over the 6 to 12 month period. That decline in perm, as we've talked about briefly, was partly linked to a loss of a large client, which was perm focused, and although a low margin client, it was also linked to the perm market softening, which we saw back in November, December last year, really turn as the economy started to slow, and then that continued into early 2023, and really since April, the perm market's been steady and stable for us. But we've yet to see any recovery in that perm market. It's just been steady. Looking at each of the sectors, the key growth areas in 2023, as we saw, were defence, which was up 19% year on year. The factors in that economy, the geopolitical situation around the world, has driven defence spending, and that we continue to see strong demand in the defence sector. The large perm account that we lost during late 22, early 23 was defence focused, and in 24 we will see some impact of that pulling on the defence business. But aside from that, there's ongoing and strong demand in the defence market. The other key growth area was in Gattaca projects, which is our statement of work business, as we talked about. That was up 59% year on year at 2.1 million NFI from 1.3 the year before, and we expect to see that growth continue through the next couple of years. The Gattaca projects business has historically, it's been something that we've done for the last 10 years. We've had a statement of work offering, but we've typically been focused on one project with one client, and we've moved from one to another. So we've never really built a consistent pipeline of business and a consistent business. What we've done over the last 18 to 24 months is really build a niche offering in statement of work businesses, in that statement of work business. And we've also built a very deep relationship with a key client. And now we're very much see ourselves embedded with that client and working on a number of projects across their business. But that's also giving us the case study and the experience to go out and win more of the same work with a variety of different clients. So we're really excited about what that business has got to come over the next few years. Infrastructure, as Matt talked about, is a market that's had mixed drivers in it through the year and continues to have those mixed drivers, but we had a good performance with 4% growth in the infrastructure market, which is our largest business sector and represents a significant portion of the group. And again, we expect to see that spending commitments affect infrastructure, and lots of opportunity there for us. Just in the other sector, which is down 18% year on year, that's where we've seen we've pivoted away from what we've called our CMR business, or consumer manufacturing and retail. We've typically done more blue collar manufacturing type work within that sector. We're moving that towards what we're badging as smart manufacturing, so a more white collar, higher skill set manufacturing type role, which we hope is going to offer more opportunity as manufacturing clients move towards more use of automation and technology, rather than always relying on blue collar labour. If you move on to the next slide, Andy. So this slide is just a pictorial reference of the previous. So if we skip on again, Andy, to the next slide. The group PBT has gone in the year from 0.3 million in 22 to 2.6 on a continuing underlying basis, whilst the NFI was down, as we've just talked about, by 0.8. We had a good saving of 2.5 million in admin costs through the year, which really is due to a number of issues, a number of factors which I'll come on to talk about, but primarily underpinned by our focus on that cost rebalancing pillar and work we've done around cost and managing cost in the year. That is combined with the benefits of the cash balance we've shifted towards over the last 18 months, where we've now generating net interest income, has given us that PBT of 2.6 for the year ending July 23. Skip to the next slide, Andy. So the admin cost bridge, as I said, we've reduced admin costs in the year on an underlying basis by £2.5 million. The first two key elements relate to our sales teams, both in terms of staff cost and commission and incentives. So although the decrease in sales staff cost was only 0.1 million, that was really a mix of two factors. During the last year, we saw about 30 headcount reduction on average in our sales staff across the year, which gave us a saving in sales staff cost. That was as we exited some of those accounts, which were low margin and quite resource heavy and resource hungry. In addition to that, our performance management process that we put in place allowed us better visibility and a better process around managing sales staff performance, and particularly underperformance, and how we address underperformance within the sales teams. So that resulted in a 30 headcount reduction through the year as we manage that headcount with the NFI. We're now at a point where we're trying to grow our sales headcount again, as Matthew talked about, particularly in the energy, TMT and defence sectors, where we see the most opportunity over the next 12 to 18 months. And through this year, we're again looking for about 10% growth in sales headcount as we start to try and grow that back. And over the last 3 months, during the first 3 months of the new financial year, we have started to grow that headcount and move towards that. That reduction in headcount was offset by the pay increases and promotions that we gave to sales teams. Recognising that we're operating currently in an inflationary environment, it's important that we continue to provide sales staff with opportunity for promotion, and also inflationary pay increases, which we did during the year, and which cost us 0.7 million. The next bar is around commission and incentives. So there is a linear relationship in the fact that NFI naturally falls through to commission, so the lower NFI number fell through to a lower commission paid. But in addition to that, we reduced the average rate of commission in the year by about 1 percentage point. So that was really due to two factors. First one was we made a couple of scheme changes at the beginning of FY23, which Matt and I highlighted last year we were going to do. So we did execute those where we felt that we'd identified the schemes were running a little bit higher than historic levels and higher than the requirement. And as a result, we were overpaying. So we addressed that firstly. And then secondly, the shift towards a higher contract mix results in a lower average commission rate, where we differentiate between contract and perm, and contract commission rates have a lower rate of commission as a result of the higher cost to serve that we see. So we counter that with a lower commission rate on contract. We've already talked about the reduction in property portfolio, but the real impact on cost of that was a 0.7 million reduction in our admin costs as we reduced the lease asset charges for the long-term property leases that we hold. So that gave us a 0.7 million benefit in FY23, and we expect to get further benefit, not quite as big as the benefit we saw in FY23, but in FY24 and 25, as we continue to look at our UK property portfolio and make sure that we've got lease office space that is appropriate for our current headcount and our growth aspirations, and we're not carrying a huge amount of excess and empty desks. We got some benefit from year on year from release of historic sales ledger credits. So these are overpayments unclaimed by customers. We'd not addressed that for a couple of years, so we had a catch up, but that is just a consistent year on year process that's part of our processes. But it gave us 0.5 million of benefit in FY23, and then the next bar is the benefit of bad debt recovery and the expected credit loss. So the first element of that 0.7 benefit there is that as we've reduced our debtor balances and our debtor balance at year end, we get a natural benefit from carrying a lower provision against bad debts. That gave us 0.3 benefit year on year, and then the balance of that bar of 0.7 was we had a substantially less write-offs in the year, which than FY22. So as a result of that, there was a lower charge. So that brings us out to the 41.1. You move to the next slide, Andy. We talked just about cash briefly. So as Matt said, strong cash performance, closing the year at 21.6 million, up from 12.3 at the previous year end. That was really just driven by the trading profit and the cash generated from trading profits, operating profits, and then the bar in the middle of that graph, the benefit of trade receivables, and which was really the reduction in our DSO. So we reduced DSO from 55 days to 47 days. That was good performance through the year, strong sort of internal processes and controls within the finance team, meaning that I think we're now at a level where I would hope that we stay at, but I don't see a huge amount of future opportunity to reduce that 47 days much more within the team. But we're now at a good stable place. There is not much more moving through the cash. Sort of no other major items to call out, but that strong year-end cash balance of 21.6, and through the next year, obviously, we have got a buyback that we started in August. So in 24, there will be some buyback costs as we conclude that second £500,000 buyback that we did. We've got the dividend payments, this ordinary dividend of 2.5p and the special of 2.5p, which will be a H1 cash outflow of 1.5 million. And then probably final expectations for cash as for FY23 is that as we are focusing on the contract book and trying to grow our contract base and our contract book, hopefully we are successful in that, and that will utilize some of that cash balance. So as you grow the contract book, that utilizes working capital and will require some of that cash balance. So I'll hand back to Matt to provide the summary and outlook.
Yeah, thanks, Oliver. I think clearly from a macroeconomic, it's going to be quite an uncertain year, and though we are in marketplaces where actually we've not really seen the demand slow down that much. We have seen the time to hire or effectiveness hiring stretch out or reduce. So we are cognizant of that, and certainly for UK and US markets, we have an interesting time coming up as well next year with the election. So conscious of it, but we are seeing okay demand. I think contract is now starting to increase a little bit out in the market. Part of my challenge is we are a business that week after week feels better as we go on our self-help, and it's balancing that with the reality of the market is a very competitive one out there, and slightly softer than it has been for a good number of years. But we're building the business in the right way. We're going to be super focused on those 4 pillars. Still, we've got lots more that we can, and we will continue to as we mature the organisation and build our confidence and our capability.
There have been a lot of questions sent in, so I shall crack straight into them. I'll try and group them around some recurrent themes. And the first one, probably leading on from what you were saying, Oliver, is concerning cash. And what do you think are all the options that you have as a executive team for using the cash for best purposes? And will that be organic, or could it be inorganic?
So I think multiple options for utilisation of the cash. Obviously, as we have been doing through FY23, we've got the options of distribution to shareholders. I think as we're now back in that rhythm of, and we've recommenced the dividend with the ordinary of 2.5p. I think getting back to that position of consistent profits and meeting our distributed in line with our policy of 50% of PAT through the cycle is obviously a first use of it. I think, as we said, the organic growth opportunity from contract growth will utilise some of the cash. That depends on when the contract comes and what type of contract growth it is, and the migration element. Often and how we win and how we grow contract, we often want the opportunity of growing large packages of MSP outsourced projects. They typically come with an acquisition of a contractor book from the current incumbent, and when you do that, you will acquire that at a lower margin and then place contractors at a higher margin. So that can take up chunks of cash, and we want to retain the flexibility to pick those up as and when they come in and we're successful with those bids. And then, as you identified, I think acquisition-based growth isn't off the table, and we would consider that. We've got an idea in our minds of what is attractive to us as a acquisition opportunity, whether in our core markets, and if the right opportunities come up, then we would be interested and we'll look at those. So nothing off the table.
Okay, thank you very much. Very lead on the couple of questions about potential M&A. Given the balance sheet and given the difficulties that others are facing in the sector at the moment, there has been a question: where or when might you consider acting on any pipeline of acquisitions that you might have, and how does that fit in with your focus on completing the turnaround of the business first?
Yeah, I think something I'm exceedingly cognizant of, Andy. I think if you look back at a 7-year history in the group, I wouldn't say M&A has been something that we would look at and go, that's been fantastic for us. And I certainly haven't hung around for 20 odd years to get into this seat to then damage the business. So whatever we do it well. We do it properly, and we do it with the right outfit, rather than just because we got cash and just because the question's out there. So we can see both how positive it can be, but we've also felt how negative it can be. So we've got a nice long journey that we can go on in our self-help, and we're super focused on making sure the whole business is focused on just being a world-class organisation. If some nice opportunities present themselves well, which culturally and market and service fit well, we'll look at them, but we're not rushing around desperately trying to do that. That's for sure.
Sounds very prudent. And then last question relating to cash. Is there a set or a theoretical level of cash on the balance sheet in, say, 6 months' time that you would see that might bring a share buyback or a special dividend back onto the agenda?
I think it's anything we've got modelled as yet. As to Oliver's point, our number one focus is let's get growing our contract book, which we're now doing for the last 5 months, and it will depend on the speed. I'd much rather be using it to be financing and growing our contract book than anything else. So yeah, no modelling, no set numbers out there.
Great. Now, perhaps we can move on to margins. A couple of questions around this. Well, we got congratulations on a recovery of the gross margin and the conversion rate. You've mentioned a target of a minimum of 10% levels for the latter, which is quite a long way below levels that Gattaca or Matchtech has seen in the past. Question is, are you being prudently conservative, or has the market actually become more difficult and more competitive?
Both, probably. I think clearly the market has become more competitive. Nothing of any value is easy, and we want to be building this in the right way. And we didn't get to those levels of previous conversion records as a group overnight. We got there over a good number of years of doing a lot of little things right every single day, and we will continue to do that with this. So for a business 12 months ago, which was talking about just about break even on almost 500 million pounds of sales, getting some conversion is the right direction, and we will continue to push that at the right speed. I think what I don't want to do in a market which is more competitive for sure is take short-term gain over medium-term sustainability of a really world-class business. And there's a very nice positioning that we just keep getting stronger each week, and the market will turn and recover. I want us to be right at the front of that queue when that happens, to make sure we missed the biggest recruitment boom, I think, in a generation a few years ago. I am making sure that we're well positioned for the recovery when it comes through.
Thank you. And in terms of NFI margin, do you see further upward progress? And if so, how do you think you can achieve that in difficult markets?
Yeah, I think we've invested a lot in our go-to-market, and I don't just mean in brand architecture. I mean in that capability and business acumen for all of our areas, and being really conscious of what type of business we're after. So I think we're certainly not there yet at all. We've started well. We've started well by offloading some stuff we didn't want and being more focused on what we do want. That doesn't mean we've changed the entire book, and we're at our levels. So I think there's more progress that we can make, and it will be interesting the speed that we can make that as the market dynamics change over the next sort of 12 to 24 months.
I think it will depend on the opportunities that come up as well in terms of the BD pipeline, and where large MSP type opportunities come up with a migration of workers, that could have a short-term negative impact on margins. However, I think during the last 12 months, we've certainly got some examples, or I can think of, where we're starting to renew work and renew projects with clients at higher margins and push up margin on contract work, which is certainly helping push up.
Okay, thank you. And now moving a few questions around the more operating side of the business. One here: are there areas of the business that have so far proved unresponsive to your turnaround program? And if so, what measures might you now be taking to move them along?
I don't think we've met any area of the business which is unresponsive. I think that's probably one of the biggest cultural shifts we've had, is that we're doing this together. We're doing it as a team. We're doing it authentically. I think there has been areas which are of higher priority, that we've had to get to first, and some which have been a little bit further down the track, and that's no disrespect for them. It's about having a proper game plan and doing it properly. But no, we're not getting resistance, and that comes back to why I'm so proud of how the business has shifted in the last 18 months. We're very, very focused on going out there and competing with the competitors and being the best in the market rather than the internal inertia. And yeah, we haven't nailed all of it, and at times I'm sure it feels a bit like whack-a-mole. But the intent and collaboration across the business has been really good. It's just the speed, and probably one of my personal challenges. I'm not known for my patience. I'm certainly known for my ambition and ideas, and it's about us not trying to do too much too soon, and the business not being able to mature and build its capability with that. And that's something I'm really mindful of. Yeah, no resistant, but still lots of opportunity for us to get much better.
Good to hear. And of course, changing culture is never easy. So we have a question: have you actually lost any valued member of staff who didn't agree with the plans?
I'm sure we have, Andy. I'm sure we have. Yeah, I'm sure there was a few where we came off the back of a number of years of a couple of different leaderships. COVID had thrown in the mix, acquisitions of people with completely different historic experiences all coming together. That naturally does change your culture or loses the clear identity of what it is. I'm sure in the first 3 to 6 months, there was a few people that left us who were testing out, is this guy really going to hold us accountable to this? And does he really expect us to behave like that? And as soon as they realized that we were building in all the processes and approaches and communications and authentic leadership, that's exactly what we're doing. I'm sure there's a few people that self-selected out, but none of that has left us a hole in our sales capability. And if there were, we've been able to bring through good people who are really wanting to do this in the right way, and provide great opportunities for them. I think if you look at our attrition over the 18 months spell, take it even back to 24, yes, attrition has dropped a lot, which is great, but equally the dynamics of that has really shifted. That would have been 80-90% of the people at a very high number deciding not to be part of this game. Now it's about 75-80% of us deciding that they're not going to be successful in the industry, and making that call quicker. So we've got a lot less of it being people, I'm opting out. It's much more about us making that decision and building this business properly.
Thank you. And sticking with personnel, there's been a number of board changes announced today.
Yeah.
Could you both share your thoughts on how that will help you in the next stage of executing your plans?
Yeah, I'll go for it. I think it comes at the right time for the business. I think we can cope with those changes now. I think Patrick has been superb for certainly for myself. I assume Oliver as well feels the same in the first 18 months to really help us find our feet and settle in, and got that balance just right between counsel and challenge, and making it feel like we are in the right seats and supporting the direction we're doing. So and with Richard coming back in, who's an individual that I hold in really high regard, I think that is a good move for us. Roz was brought in with a specific purpose a couple of years ago when we weren't sales focused, and now we are. So it's kind of mission accomplished. So thanks to Roz on that. George is more emotional. George has clearly been here since day one, and we've got hundreds of thousands of people who have got different career opportunities because of the baby he created. I see that as a real sign of confidence and backing from George. I'm sure he would have loved to step down maybe 8-9 years ago, but we had numerous things internally we needed to get ourselves through. And I see that as a real sign of his confidence and belief in the whole team at the business that we've got this, and we know what we're doing and we're going to do it in the right way. Yeah, there are some changes, but I think that gives us a smaller, streamlined, but highly capable board, really motivated for this positive next chapter for the group. So yeah, I'm sure we'll have some fond farewells for George over the weeks and months to come. But I think, yeah, we just appreciate the opportunities that all of them are presented.
Yeah, I mean, I think.
Sorry, mate.
I think, yeah, a smaller, more streamlined board going forwards. As Matt said, Patrick was 18 months in the role. He's been incredibly supportive and really given me the support that I needed during those first 18 months. I'm looking forward to working with Richard. I didn't really know him before when he was on the board, but I know of his experience both with Gattaca in recruitment and then his previous experience in the sector with what became Impellium Group. So I'm really looking forward to that sort of sector knowledge and sector insight. And yeah, like Matt said about George, I think it's a great, I guess, sign of George's confidence in us that in the business as a whole that he feels now's the right time to do that. So yeah, I'm looking forward to the new board and working with everyone.
Nice unified front there.
Well, I think I said those things, Andy, didn't I? So it's very, very poor form of me.
Just a couple more to go. What do you see as the biggest risk to you achieving your ambitions for Gattaca?
Personally, I think it's that comment earlier around not trying to push things too much too quickly. I mean, I've had a very fun, exciting, rewarding, and I'd hope productive career at the group. But as I say, I've had many an exciting idea, and more than 2/3 we've nailed them and done really well. But there was another third that I'm still tidying up some of the mess of. So it's making sure that we are consistently doing things in the right way, and we're bringing the entire business from. I think the market changes are really interesting at the moment because we're still in self-help, and it might slow us down a bit, but it's not stopping us. So for me, it's just knowing when the time is to, how did Eddie Jones put it? It's knowing when to squeeze and put a bit of pressure on, or release and take a bit of pressure off. And it's just getting that right balance as we go along this journey.
Yep, sounds sensible. And then last one, Gattaca is a STEM specialist. How do you feel AI might impact the way you run your own company, as well as the markets that you are trying to serve and be active in?
Yeah, no, it's a topic we're often talking about internally and externally. I think from an internal point of view, clearly it has the potential, and we're already using it in a few different capacities to help speed up productivity for a new consultant. How do you get their knowledge up to speed? How do you get their insight better? How do we attract or engage candidates or clients? So there's lots of potentials internally, so that will be interesting, and I'm sure, like we as a business and staffing as an industry, it will work those out, and it will learn to be the best at those various bits to help the boat go faster. I think externally it could do a lot of things, but how that evolves, I'm sure we'll be hiring a number of AI activation officers in the years to come, and I'm sure we'll be hiring a number of kind of AI governance officers in the years to come. But there's also still going to be a requirement for current and evolving skills. So I think it's exciting. I mean, I've been here 22 years. I think when I first joined, I was one of the first people brought in to set up a software engineering capability, which was a new terminology to us as an organization, and there weren't many of them about, and there weren't many people who needed them, and now it's one of the single biggest in demand skills globally as software developers. So it will evolve, and that's exciting. That will present great opportunities for some of our customers. It will create new customers, and it will create different marketplaces. For us, it's about being externally focused enough, if I want to hang it off my pillars, that we are really cognizant of how it is impacting, and we're at that front and center of engagement with our customers to support them on that journey.
Great. Well, on that very positive note, I shall say thank you to our audience for their attention and a wide range of questions. I would remind them that this deck will be available on the Gattaca website, and there is also a detailed research note about these results and the outlook for Gattaca that has been published by Equity Development today, which is on our website. Thank you to Oliver and to Matt for such a clear presentation, and wish you all the best in phase 2.
Thank you.
Thanks very much. Thank you very much, everyone.